Friday's weak jobs report and Monday's market rout have spiked recession fears and placed pressure on the Fed to cut rates. For a closer look, let's bring in former Boston Fed President Eric Rosengren. He's now a visiting scholar with MIT's Golub Center. And Eric, it's good to have you on today. Good to have any of you gentlemen that have, or ladies that have actually been there when these decisions are being made to get an idea of what's going on. If we could be a fly on the wall. Do you think at this point there's anyone on the Fed who's considering an interim cut or would consider it if the data continued to deteriorate in terms of the labor picture?
I think the conditions would have to deteriorate very substantially to do an intermediate cut. So intermediate cuts indicate that there's a severe concern that without taking action, you'll end up having a bad outcome for unemployment or inflation. That's not the situation right now. We've had some substantial volatility, but I don't think it actually tells us very much about the U.S. economy. The main reason we're seeing this volatility is that many traders were very comfortable borrowing in Japan and investing in risky stocks in the United States because both the Bank of Japan and the Federal Reserve were on hold. Once the Bank of Japan made it clear that they would be willing under some circumstances to raise rates and the Fed would be willing to lower rates, the exchange rate risk on that trade becomes very substantial, and those traders start unwinding those positions. So I think it tells us more about financial positioning than it does about what the underlying strength of the U.S. economy is.
What's the next data point, do you think, or the next 3 or 4 that are going to be the most important? And do you think, Eric, that it's definitely economic data, or will market data? By that I mean if there was another data like we had on Monday. Let's say there's a couple more of those. Would that, then you wouldn't need the economic data to get the Fed to act, or do they need to actually see it? Because it's a lag, Eric. They don't know what's coming, and the market might know before the economic data.
So you're right. The market does anticipate things they think are going to happen, but you have to ask, what are they anticipating? So far, if you look at private sector forecasts, if you look at the Atlanta Fed GDP now, they're actually indicating GDP growth for this quarter, likely to be somewhere between 2% and 3%. GDP now is close to the top of that right now. I'd be closer to 2.5%. But we're just not seeing much in the way of underlying economic data that would indicate that financial markets are actually signaling a problem. One reason the Fed sometimes reacts to significant changes in financial market pricing is because they're worried about broader financial stability risks, that banks or other financial intermediaries are going to start having significant problems. But right now, most banks are well capitalized and in a pretty good position. There's no obvious financial instability issue here, and the economy continues to be doing reasonably well. So if we thought that there was undermining of confidence of both businesses and consumers, that might be a reason to do more in September or at future FOMC meetings. I don't think it would be a reason to do anything between now and September. It also looks like the Fed is, in effect, a panicked reaction to changes in financial market pricing. And to be honest, we've had a pretty good run-up over the last couple of months. It was probably not unanticipated that at some point there would be some declines. And if financial markets and financial traders are poorly positioned for a change, they need to exit those positions quickly. But that doesn't tell us much about the underlying economic conditions of the U.S. economy.